Good afternoon, everybody, and welcome to the Tax Investigations webinar for February. Thank you for joining us or watching the recording. If you are live and joining us now, you can ask us questions by typing in the question box on the right-hand side. We're more than happy to take questions at the end of this presentation. So you're joined today by me, Dave Jennings, Tax Investigations Specialist Expert here at Churchill Tax Advisors, and my colleague Imad Ilyas, who's also the Head of Tax Investigations here at Churchill Tax Advisors. We both have many years of experience dealing with HMRC and various investigations. Myself, nearly 20 years inside HMRC as a Senior Inspector of Taxes, investigating businesses and high net worths, etc. And the last decade or so, we're working for various firms of accountants, helping clients and accountants with their own clients, and solicitors as well, other introducers with problems with HMRC, making disclosures, settling investigations, taking the stress away from the problem of disputes with HMRC. So today we are going to talk about HMRC's nudge letters and also Code of Practice 9, a reminder for everybody around these topics of nudge, where the revenue don't really open an investigation, but obviously it's a warning that they will open an investigation. If you don't respond, it's a very gentle, friendly, you may say, nudge for people to comply if the revenue have got some information, which sometimes might be wrong, in order for people to look at that. And Imad is going to cover that point, and then I will cover a refresher about the Code of Practice 9, serious fraud investigations, and how they work and what happens. So without further ado, we will start the presentation, which is at the end of the presentation. So we'll just whiz back to the beginning. Please don't look now, it gives it all away. Spoiler alert. Right, excellent. Here we go. Imad, thank you.
Thank you, Dave. Thank you for the introduction. So the way we split the presentation is I will be doing the, let's say, it is serious, but not as serious as what Dave is going to cover with Code of Practice 9. Now, essentially, the approach behind the campaigns, and we've got various campaigns listed on the screen: the Let Property campaign, Worldwide Disclosure Facility, Digital Disclosure, Voluntary Disclosure, and COP9, which is what Dave will cover. The other disclosures, these are aimed at getting taxpayers to correct and giving them an opportunity to correct their position prior to HMRC opening a full-blown inquiry. So let's start. As Dave pointed out, these are called nudge letters. So HMRC have a database called Connect. Now, the database, this is a mega database that has got information from all different types of sources. So in terms of, let's say for an individual taxpayer, they will know what properties, bank accounts, credit cards, the car, all these type of information. And then they have a system which will create a prompt for them. So the idea behind these nudge letters is that HMRC would send out letters to people to encourage compliance. It's not a legal requirement to reply. This is an important point, but it is very much advisable to do so, because we've had cases where people come to us and ask for our advice, and we will always tell them, if there is something that needs to be declared, you need to do it now, because at this stage, the terms that are being offered will be a lot more favorable. And then if you go back to them and say, no, there's nothing to declare, it doesn't go away. It's quite the opposite. There have been instances clients have approached us where they've done that, i.e., ignored the nudge letters, and ended up in a serious sort of an investigation. And of course, what happens is that when there's a full inquiry and an inspector is appointed on your case, you don't have that level of control. You're driven by their questions, so it can take as long as it takes for the inspector to be happy. Whereas with these nudge letters, the sort of disclosure facilities that are offered, they are very standardized, and they give they give a more flexible approach, a more systematic way of declaring your any sort of previously undeclared incomes or gains. So let's look at the first one, Let Property campaign. Essentially, this campaign is used where you are someone who's got undeclared rental income, and HMRC, again, we've already mentioned the Connect system, so they will have details from land registry. They'll have details from other sources, from the mortgages that you've got, and from the sort of sale documents where you have sold properties. So they might send you nudge letters, and if you're someone who has undeclared rental income, then you would go down the route of the Let Property campaign. Also, another thing that we should be mentioning here is HMRC can nudge you, but if you do know that there is something that needs to be corrected, you can make what's called an unprompted disclosure through these facilities, and it's more favorable than a prompted disclosure, prompted through the letters, the nudge letters that you get. The penalties will be a lot less, and the process is pretty much similar, but what we've seen is terms will be a lot more lenient. Now, the Worldwide Disclosure Facility is, again, a very similar campaign, but it's for income. So it's primarily for gains, offshore income and gains. And again, the same principle applies. If you have undeclared offshore income or gains, being able to do the disclosure before being prompted to do so is a better option than being prompted, because prompted disclosures will result in higher penalties. And we've seen a lot of cases for this. There are increased number of inquiries, and it's come about due to the common reporting standards, whereby different countries are now starting to share information related to tax, and that's made it a lot easier for HMRC, and it's given them more transparency to see where taxpayers are not declaring their income fully. It might not always be the case that that this income was missed out knowingly. Quite a lot of the time, the clients that come to us, especially the Worldwide Disclosure Facility, the matters are so complicated, and they are being declared in another country, and there's tax being deducted. It's very easy to be confused, to think, well, its tax has already been deducted at source, so there's no more liability. Even in that case, for most clients, it needs to be reported in the UK. It might not mean that there is a tax liability, but it still needs to be reported. Dave, do you want to add something here?
Yes, certainly. We've seen a lot of cases where HMRC have got bank information from India, for instance, and they get a snapshot of an account, or a balance on the account, or transactions that have happened. Same with America. We've seen cases where HMRC in the UK have got information of share transactions, for instance, in America, or share option schemes. Things like that have been given to HMRC in the UK. We obviously then look at the individual circumstances and make any necessary representations and disclosures to HMRC. Sometimes the revenues information may be incorrect. It may also be that the banks have made errors. I'm handling a couple of cases at the moment where the offshore banks have actually made mistakes on the amounts, or have reported the wrong year, particularly around cases that might have historical issues from the banking crisis. Some of the banks at that point in Europe that maybe went under, then came back out from administration, and some of the way that the funds were compensated give a skewed impression of the income. So those matters need to be carefully addressed and looked at as well. And as Imad has already mentioned, whatever you do, don't ignore these letters. We have picked up clients where they may have ignored a letter last year or even in 2019. It's inevitable that the revenue will open an investigation if you ignore the letter. It may not be immediately, it may be a year hence when HMRC's got the resources to open an inquiry. But ignoring a letter is never the best policy. Always seek specialist advice when you receive such a letter saying that the revenue have information and inviting you to respond. It may not be a legal requirement to reply, but it would certainly be advisory to get specialist help from somebody to decide on how to respond.
Thank you, Dave. I think you made a very good point, and my focus is around not ignoring the letter. So, and you mentioned the point that let's say there is a mistake on HMRC's side. They might be going after you, where they might think you've had some income, but in fact you haven't. Even in that case, you have to make sure that it is explained in a clear-cut way, and it's done in such a way that, you know, even with that reply, you're not looking at an investigation some years down the line, or a year down the line, or months, depending on resource availability for HMRC.
With the worldwide disclosure as well, there are potential issues and complications around residence and domicile and taxation and remittance basis. It can get quite complex for some people, depending on how long they've been in the UK, and those points need to be considered as well.
Excellent. So now the other one that's called digital disclosure. So we've looked at lead property campaign and the worldwide disclosure. Lead property campaign is for rental income. Worldwide disclosure is for offshore income and gains. And then they've got this digital disclosure facility, which essentially is a net that captures anything that's not covered under lead property campaign or worldwide disclosure. So could be something to do with CGT, could be something to do with income tax, corporation tax. It's not to do with VAT, because we've got something, VAT can be declared through a separate mechanism. So it's depending on the threshold. So if the errors are below the reporting thresholds, they can be adjusted within the VAT returns. If they are above the reporting threshold, then we need to prepare what's called a Form VAT 652, and just have to explain the reason for the error. To explain, you have to be able to show why the errors happen. You have to obviously do the calculation and be able to show what the additional tax VAT liability that is due. And again, even when something like this, Dave, I feel even in things like this, you have to be careful on how the explanation is provided in terms of the behaviors that led to that error, because that will impact the penalties.
Absolutely, and equally, you've got to be mindful and careful whether it affects other years as well, and the amount you got to be wary of. And you sometimes hear this from people say, "Oh, well, my mate down the pub, he said just put in an amendment for 1 quarter, just deal with 1 period. The revenue won't know about the rest of it. They won't know about the previous periods or the previous years." That's extremely risky, and obviously we could never advise on that line of things. And HMRC are not daft. If you make an amendment or adjustment, be it VAT or be one of the other disclosures, the revenue will always check the information. They always check their sources, and they have a right then potentially to open an investigation. And obviously, if they start asking questions and delving deeper, then you're going to be in a really serious problem if you've attempted to hoodwink the revenue.
Exactly. And just on the point where you say, you've heard something from your mate, that's something you should always ask specialists even in normal compliance matters, such as when you're preparing accounts, VAT returns, or tax returns. You should be seeking the help of a professional. Even in things where there have been errors and the past years are concerned, certainly professional help is very, very advisable. Over to you, Dave.
Yes, thank you, Ahmed. So I mean, almost led on to it there, where if you're not making a full disclosure, then that is committing tax fraud. That's tax evasion, not avoidance. Evasion, tax fraud. So if it's tax fraud, then you may be prosecuted by HMRC, face a prison term or an unlimited fine. We do see that in the press. You do see cases where people have been sent to prison for tax fraud. There is no bottom limit necessarily on the fraud. Obviously, the revenue only take the more serious cases, but sometimes they may want to set an example to somebody in a particular community or a particular sector. And if the evidence is beyond reasonable doubt and they think they're going to win a case, they will prosecute. It's out of the revenue's hands whether they actually do prosecute. It's down to the Criminal Prosecution Service, CPS. They decide the cases to prosecute. So the revenue give a file and pack to the CPS with a recommendation to prosecute, but they make the final decision based on the evidence and the possibility of a successful prosecution. No prosecuting authority would want to take cases they're not going to win. So if you're in that situation, then obviously it's got extremely serious. However, there is another option outside being criminally prosecuted, and that is a civil investigation of fraud, which is the Code of Practice 9 regulations that cover this matter. And there is also linked to that the Contractual Disclosure Facility. They are both the same thing. CDF, COP9 are both the same thing. COP9 has been around for many, many, many years. CDF was brought in more recently as a way of tightening up the procedure and process to stop things lagging, or to stop there being a framework around Code of Practice 9. It just puts a bit more of a process around the system. So I'm going to cover that process in today's talk. As I've mentioned, it covers cases of deliberate behaviour, which is deemed to be tax fraud, tax evasion. Old school was fraud and evasion. New school is deliberate behaviour, as opposed to careless behaviour or mistakes. And within this process, the regulations also allow higher penalties in the more serious cases. And equally, probably what's of more concern is that if you are accused of fraud, or if you admit fraud, which we'll cover that shortly, that can be an advantage to admit fraud, you do have to disclose, or the revenue does have a right to go back up to 20 years to assess. So very, very serious. The way Code of Practice 9 works is that if the revenue have instigated the investigation, they will give you 60 days to respond. Unlike the nudge letters, where you may choose to ignore it at your peril, with a Code of Practice 9, there is no way you can ignore it. It will not go away. If you don't respond, there is a risk of criminal prosecution. If you do respond, there is a risk of criminal prosecution. You have to do it right, and it's important that the outline disclosure does cover a rough idea of what has taken place, what has happened. Again, there are two options to respond to that. If, on the other hand, you are asking the revenue for Code of Practice 9 and making a voluntary disclosure of fraud, then why would you do that? Well, you would do that because this procedure, the Contractual Disclosure Facility, is a signed document. It confirms that if you agree, so your part as a taxpayer of the contract is, I will disclose everything, I will cooperate with HMRC. What HMRC will do, their side of the contract, they will guarantee an immunity from prosecution. So that can be extremely important for some people. They just don't want the risk of being prosecuted if they admit they've committed fraud or deliberate behaviour. If you've done something wrong, then you don't want it hanging over your head that you might be prosecuted. Far better to come forward and achieve an immunity from prosecution in this process. But if the revenue open an investigation, and on searching your file and documents, going back into your own mind and the past, then you can deny the revenue's suspicion. If there is nothing that you've done wrong whatsoever, and we would never force somebody to admit to something they haven't done, it's not the way forward. Some people think, and some people may have advised, say, well, you admit to something, admit to anything, because you'll get the Code of Practice 9 protections. Well, you can't admit to something you've not done. So it may be more important to make a denial. There is no third option. Many, many years ago, there was a third option of deny and cooperate. You could tick a box. That has gone. And for a number of years, that has gone. You either admit fraud and go down that route, or you deny it completely. But obviously, you can still cooperate with HMRC's investigation. The risk is if you deny the revenue's suspicion, then they may prosecute. Who knows whether they will or not. You could say, well, if they were going to prosecute, they would have done so already, rather than offering you the Code of Practice 9. And that may be true. It is obviously a risk. We would always say, if you're going to deny the suspicion of fraud, you still advise HMRC that you will cooperate fully with their investigation. It does mean that a denial will result in HMRC doing a full-blown investigation of potentially the last 20 years. And they have various powers in which they can compel information and documents, Schedule 36, for instance. They can issue assessments, etc. So if it has been prompted by HMRC, then, as we've already mentioned, it is pretty much a last chance to avoid any risk of criminal prosecution. So what do? You have those 60 days. So in those 60 days to respond, you submit an outline of what you know to be deliberate behaviour, or what you know to have been a fraud. It's more than just a mistake. It's more than just carelessness. It's something that you did knowingly and deliberately. That could be as simple as you knew a tax return should have been submitted and you didn't submit it. You didn't submit it on purpose. It wasn't because you just didn't get around to it. You knew you should have done and you didn't. It could be that you've got a property you sold, and you didn't just forget about it. You didn't just realise. Didn't understand the tax consequence of selling a property. You knew that it should have been reported. You knew there was a gain there, and it should have been told to HMRC. If that's the case, then you've committed fraud. and that should go in the outline disclosure. I sold a property 3 years ago. I didn't tell the revenue. We can come to trying to mitigate penalties and explanations later. You can give obviously some information on the outline disclosure. This is not a full report. It is an outline. It's a brief. It's a headline summary of what has happened. It should also include any non-deliberate mistakes, carelessness, alongside that. And then once that has been submitted to HMRC, they will consider that report. We'll come to that in a second. So on voluntary disclosures, same thing applies. You approach HMRC to say, I want to make a voluntary disclosure of fraud. And again, to repeat, you would do that because you can then get an immunity from prosecution. If the revenue hadn't already instigated or started a potential prosecution, then this will give you an immunity. You will be guaranteed no prosecution, providing you make a full disclosure and cooperate with HMRC. So you have the same 60 days, same forms, same outline. You tell the revenue, this is what happened, this is what may be involved. You don't have to give an exact amount of tax liability, give an estimate if it's possible. Otherwise, it's just a consideration of behaviours and what have happened potentially in the last 20 years. Again, the revenue then will consider that outline disclosure. When they consider the outline and they accept the outline, they will then offer you the Code of Practice 9, and then you move forward. In either cases, be it a prompted or unprompted disclosure, there will be an opening meeting with HMRC in which they will want to ask all about you and your business or tax affairs, potentially going back 20 years, or it may be limited to a specific period.
So
fine, Imad, you can chip in, please do.
Yes, just listening to what you've been saying, and I thought I'll add a little bit. Just on the part about the entering into CDF, it is, from the way we look at it and what we tell our clients, it is there can be a lot of people, again, with like I said with the other disclosures, some people will say, well, no, I'm not going to entertain this. I'm not going to sort of enter into a contract for CDF. It is very advisable to do so. I mean, it's advisable to enter into a contract and go down the route of CDF, because it gives you control, and it will give you, more importantly, it will give you immunity from prosecution, provided it is a full disclosure and you are fully cooperating. At COP 9 stage, you have to be aware that if the investigation is with HMRC, you have lost your immunity from prosecution. And B, COP 9 is a lot more serious than the other disclosures. So you've got highly trained fraud investigation officers that are looking at your tax affairs going back 20 years. They will look at it all they want, and they can ask you as many questions as they want. It will be a more, if they're looking at it, it takes, what we've seen is it can go in any direction that they want. You would rather have control yourself. So now, if you have decided to go ahead and you've been given the chance to make an opening disclosure, again, this document has to be very carefully drafted, because everything depends on this document for you to be granted, for your disclosure to be accepted, for HMRC to say, okay, should we give them the CDF opportunity for CDF or not? So again, me and Dave, we've done quite a lot of these, and we sit with our clients, we ask them many questions. The idea here is to word it carefully and to ensure that you're not, let's say, somehow you we've had cases where I'm about to finalize the initial disclosure, and the client says, oh, Imad, actually, I forgot to tell you about this business. which I was running for 5 years, but I never declared anything on that. That will mean that they won't accept you into the disclosure. It's very important to have this document carefully drafted, and it includes everything that you can think of.
That's a very good point, Imad, and I have seen and clients have come to me after HMRC have rejected outline disclosures, or cases have rumbled on after rejecting an outline disclosure. If they reject an outline disclosure, you lose control, and we'll just cover very briefly shortly what control means. But if the outline disclosure is rejected by the revenue, then you lose control. The revenue are then on the front foot. They will be commanding the investigation. What do we mean by losing control and keeping control? Well, keeping control means that you, or us, obviously the specialist, ourselves in this case, would be able to draft the report on behalf of HMRC. So if we're in control, then we do the investigation. We submit the report to HMRC, they review it. That means that we keep the revenue at arm's length for the length of time that the report is drafted. Obviously, the revenue need to see progress of that report as you work through it, and you've agreed a time limit with HMRC, at the end of which a report is compiled of the last 20 years, or whatever has been agreed with HMRC as part of the scope. So as I mentioned there, you'd have an initial meeting with the revenue. The advisor, ourselves, would have a meeting with HMRC separately to discuss the scope of that report. That will be something that would give the revenue sufficient comfort that it covers all their suspicions. It gives the revenue sufficient comfort that the tax disclosed is correct and that all the information has been given to the advisors. It is important that you use a specialist for Code of Practice 9. The revenue do ask an advisor, have you got experience of Code of Practice 9? Have you helped clients through Code of Practice 9 previously? Have you completed Code of Practice 9 reports? If your answer is no to all those questions, the revenue may suggest to the client, the taxpayer, that they seek a specialist advice. The reason for that is Code of Practice 9 is extremely high-risk work. It is extremely important work. There is a risk of criminal prosecutions. Some advisors may have insufficient insurance cover to do that type of work as well. So it is important that you do seek specialist advice. And the revenue want taxpayers to be protected by their advisor too, which is why they suggest in the Code of Practice 9 guidance that they seek an advisor out and not just an accountant. And we're not downgrading accountants here whatsoever. Accountants are extremely good at the work they do, but if they're inexperienced of Code of Practice 9, there are specific issues that crop up, which is why HMRC say in their guidance, don't go to an accountant, they say go to a specialist Code of Practice 9 advisor. And that is because it is very serious. If you had a criminal prosecution, you wouldn't go to your bookkeeper. If you had a criminal prosecution, you would seek a specialist or potentially a lawyer if it's going to involve the courts. Obviously, we do provide service to criminal prosecution cases as well as civil cases, but if it's criminal and it's involving the courts, then obviously you need a lawyer to assist, and we work alongside lawyers. So that's how important it is. You know, treating it in the same way that you might need a lawyer in a legal problem, you might need a Code of Practice 9 specialist in a Code of Practice 9 issue. So after you've agreed the scope of that report, you draft the report, the revenue review it, they may challenge some points in the report, they may just accept it, and case closed. Obviously, at the very, very end, you still have to negotiate the penalties. And what comes out of it is a settlement contract, which includes any tax that's owing, any interest that's due, plus the penalties that you negotiate and agree with HMRC based on the behaviours and the facts. There is always a risk that if there's a failure to cooperate fully, that the taxpayer could be named and shamed, which means the revenue publish it on their website. They give they used to give quarterly reports. With COVID, they've not been as frequent, but people can be named and shamed for being deliberate defaulters and committing fraud. Equally, if then somebody ends up being deemed to be a deliberate defaulter, then the revenue will keep a close eye on them for the next period of returns. Again, it all depends on what is in the report, what has happened, how it's been mitigated, what those behaviours are, how much cooperation has been held with HMRC. So thank you for listening today. We will cover some questions if any questions have been raised to us. I'll let Imad give a quick summary as well. So we've covered the nudge letters where the revenue are sending out a warning, if you like, of we've got some information about you. We're not going to open an investigation today. Please check your records. If they're wrong, let us know. If they're correct, let us know. And we would say, take advice. Don't ignore it. Don't reply without taking advice, because you may be replying in the wrong manner, in the wrong way, with the wrong information. I've then covered the situation where if it's a very serious suspicion of tax fraud, then Code of Practice 9 will be instigated by HMRC, or on the alternative, if you know you've committed tax fraud and the revenue haven't opened an inquiry yet, then seek a voluntary Code of Practice 9 to get the immunity from prosecution, which is vital for anybody who's in that situation.
Thanks, Dave. Yes, one of the, I mean, you've done, you've fairly covered almost everything in your summary. What I wanted to stress on is the fact that once you are accepted, I'm focusing on the Corp 9 now, once you're accepted into the CDF and they've accepted the outline disclosure, you still have to keep showing that there is progress. So this is where it says it's a risky, like you've pointed out, it's a very specialist procedure. They will constantly ask for updates, and at every point they need to be satisfied that sufficient progress has been made. Otherwise, they can, at any point where they're not satisfied with the work you've done, they can easily take over the investigation. So it's very important, and it's a very delicate process to manage. The other thing is obviously going back 20 years, there can be challenges in terms of gathering information. So, I mean, we've been doing it for many years and we know how to encounter them. And this is where it gets into, this is one of the other things which makes it quite a specialist area.
Yeah, no, good. Thank you, Imad. So there's our contact details. You can send me an email, d.jennings@churchilltaxadvisors.co.uk, or you can send Imad an email, i.ilias@churchilltaxadvisors.co.uk, or look on our website for contact details of the main office and team. So we'll cover some Q&A if you have any questions. So someone has been asking if you do get one of these WDF nudge letters and you need to make a disclosure, what happens if you've already paid some tax in the foreign country in which the income has arisen? Well, you do get credit for that tax that has been deducted. The UK, with double taxation agreements, you're not paying tax twice. So if for instance the income was in the USA and you paid USA taxes, then you should get a deduction in the UK for that USA tax. What you don't get is you won't get a refund of USA tax in the UK. So if your UK liability is less than the USA liability, and therefore you've paid more tax in America than you did in the UK. The UK don't give the refund of American taxes. If you're in that situation, then obviously you need to go back to America and ask America for a refund if one is due, or otherwise, that's just the situation. That's the way it falls. The main point being is you don't pay tax twice. Someone has asked about the code of practice 9 position. What happens if you miss you miss the 60-day deadline? Well, it can be unpredictable. What we would always say is if there are, and the revenue have been reasonable. We've taken over a couple of cases where clients have come to us very late in the day on the 60-day deadline to submit the outline disclosure. If you've either been waiting to decide what to do, or if you've had obviously family issues or health issues, COVID is affecting the business or you personally, then HMRC are willing to consider the situation and they will extend the deadline in particular circumstances. So it's not the absolute end of the world, but it is crucial and important to approach the revenue still before the deadline to try to agree an extension if it's required. What you don't want to be doing is rushing like mad at the last minute trying to draft up an outline disclosure that ends up being rejected. Far better to agree with HMRC if possible an extension to that deadline in order to do a full and proper review and outline to HMRC. During the actual process as well, again, if there are issues that are happening, if it's difficult to get information from the bank, if it's difficult to get information from overseas, for instance, then you can always extend the deadline by HMRC agreement. They're not guaranteed they will extend the deadline, but if you've got facts and circumstances, you could extend the deadline.
Yes. So just on that point about the deadlines. So it's very important to get it right, because especially on the outline disclosure, you sign a form, they make you, it's like a full declaration that you're making. So it's not, once it's been sent out, it's been sent out. You can't then say that, oh, actually I forgot to add this, I forgot to add that. So whenever we are preparing these, we don't, what I normally would do is I'll speak to the clients to say, look, I have sent it. I need you to let me know that you've read it. I will ask you that you're understanding it. Or perhaps sometimes if I feel I need to quiz the client to see if they've actually read it. So I'll say, okay, tell me what I've written in it. Because it's so important to get it right. They won't accept, oh, actually, I forgot. Then they will say, but you haven't read the whole, we've given you an opportunity, you've read the whole, you've said to us that you've read the whole guidance, and yet you missed something that we were expecting you to include in there. So if you're not sure, we would, if time is an issue, we try and ask for more time. It's better to be slightly late than submit something which can expose you.
Yeah, that's a good point as well. Right, thank you, Imad. I think our time is coming up now to close this webinar.
One question. I didn't give my background, and there's a question about what is my background. So Dave has done a brief introduction. I'm the head of tax investigations at Churchill. My background is essentially so whatever we've covered in the slides. Let's put it this way: disclosures, different types of disclosures, different types of investigations, code of practice. We've covered code of practice 9. I have a lot of experience in code of practice 9, code of practice 8. Other types of investigations. I've helped a lot of clients with the alternative dispute resolution, and there are clients who were under POCA inquiries that I've assisted with. So under the umbrella of tax investigation, I have pretty much come across everything that you can think of. Yes,
as have the team here at Churchill Tax, with many years' experience across all different tax issues that HMRC might throw at us. or disputes that we come across. So we're a very experienced team here at Churchill. Thank you for that, Tim. I didn't spot that question. Right. Thank you very much, everybody. We've run out of time. If you want to watch a recording of this, please do so. Equally, join us in 2 weeks' time, where our colleagues will be discussing a latest tax planning, tax technical update, and we will be back in a month's time with some latest news about tax investigations. Thank you again for joining us.
Thank
Bye.
you. Thanks. Bye.